What to do with Amazon? They just announced a 20-for-1 stock split as well as a $10 billion stock repurchase plan. And you're wondering, Eric, what do I do with this stock? It's below $3,000. It's been trading sideways to lower for almost 2 years. I'm about to give up on this stock. What should I do with it? I'm going to break it down in this video. It's my largest holding, so I know this company very well. I'm going to break it down in the video, show you some things in the news, what's going on, give you some predictions, not only with the company, but also the share price. You're going to want to see this one. Stay tuned. So just on Wednesday, March 9th, Amazon announces a 20-for-1 stock split, a $10 billion share buyback plan. Now, this is the first stock split since 1999, and it's the fourth since their IPO in 1997, but they haven't done a stock split, guys, for 23 years. What I find is really interesting is this $10 billion buyback plan, because what it's telling you most of the time is it's saying, hey, we think our share price is undervalued, and we can't get a better deal anywhere else. And I find that hard to believe, because what about all these other companies that are beat down? Now, the hard part about Amazon making an acquisition is it has to get approved through Department of Justice, which is always a challenge when you're a behemoth like this. But you have to scratch your head and wonder, are there opportunities out there with some of these public companies that have just been absolutely demolished and beat down that they could have maybe acquired instead of, $10 billion isn't a ton of money for a $1 trillion plus market cap. But for $10 billion, there's a few businesses out there that look pretty attractive, and it does make you wonder. So it's their first stock split, like I said, since the dot-com boom, telling investors that they'll receive 20 shares for every share they currently own. Of course, the stock pops 6%. And we're going to discuss in this video what a stock split's all about. Does it really mean anything? Does it really mean anything in terms of the valuation of the company? If you take a pizza and you cut it into 20 slices, it's still one pizza, right? But it does a few different things, guys. The first thing it does, allows more investors to buy more shares. It's a psychological thing. You say, well, what about fractional shares, Eric? Well, not everybody can do fractional shares. You have to remember in Europe and other international investors, not all of them actually have access to fractional shares. The other thing it does, when you think of contracts for options, 100 shares is one contract. And of course, when it's $3,000 a share and you have to buy 100 shares, it gets really expensive really fast. So it does a few different things. It can create more volatility, but it can also sometimes make the stock run. Usually, if you look at the data, it's very short-lived, and longer term, it doesn't really impact the fundamentals. But there are a few things that it could do that could actually help the stock, believe it or not. I'm one of those believers. It's like, again, if you have a pizza and you cut it in 20 slices, it's still one pizza. But there is some evidence that it could benefit the company. We'll talk about that here in a minute. Stock splits are cosmetic and do not fundamentally change anything about the company, other than the possibility of making the shares accessible to a larger number of investors at a cheaper price. So the stock is a little bit higher now. At this article, it was $2,785 a share, and it would basically take that to $139 a share. So you get 19 additional shares for every one that you own, of course. Now, what's interesting about this, guys, is that Google, Alphabet, just announced a 20-for-1 split in February. Now, if you remember, in mid-2020, Apple disclosed a 4-to-1 split, and there's other companies that have done splits as well. Andy Jassy, of course, took over for Bezos. And there's a key reason here in this article that explains why Amazon might have decided to do a stock split right now. In quotes, the split would give our employees more flexibility in how they manage their equity in Amazon and make the share price more accessible for others looking to invest in the company. So you probably saw this in the news, guys, but last month, Amazon boosted their maximum base salary from $160,000 all the way up to $350,000. That's primarily because there's more competition in the labor market. The shares, of course, have underperformed. They've kind of traded sideways to lower since the pandemic. But here's the thing I want you to focus on. Amazon, which has recently made adjustments to its compensation strategy, said the latest change is targeted to help corporate staffers. So this might be more about an HR thing and just their employees than anything else. Because of course, if one share is $3,000, that's more complicated than if it's $140 or $150 a share. What's interesting is they haven't done a split for a while. So if you look at this, 1998, they did a 3-for-1, and then January 5th, 1999, they did a 2-for-1. Amazon shares are up more than 4,300% since its last split. Not saying that it's going to do that again, but it's an interesting stat nonetheless. So here's where the speculation comes in. You say, well, now if all the big tech stocks, Google is doing a split, so now it's not as expensive. Apple is much cheaper. there's only one big cap tech stock left that's actually going to be trading at a higher price. And maybe this is a battle to see who can get into the Dow Jones Industrial. So Amazon's 20-to-1 split makes it more palatable to join the Dow Industrials. And maybe that's also why Alphabet did it as well. And you think about this, NVIDIA also did a split recently too. So are they trying to get into the Dow? It's a possibility. Does it really impact the fundamentals of the business? No, although institutions, generally funds, are going to have to buy more shares of the company, for those different ETFs and things like that. So, you can argue both sides of the fence, but I think it is interesting. If you look at, Apple, since they did their last split, the stock has done really well since that split. NVIDIA, it ran really hard and it's kind of pulled back. It's hard to say what's going to happen with Amazon. What I want to focus on this video is it actually worth $3,000 a share, even if there wasn't a stock split? And I can argue that I think it's undervalued at $3,000 a share or less. And I've been saying this for a while. It got down to $2,700 a share. I'm going to show you some price to sales ratios and some things later that will make this really interesting. And you might think twice about it of where the stock might go from here, because there's a pretty good chance this thing's going to be higher, not lower, when you look 12 to 18 months out. So this is interesting. They're talking about which companies might get kicked out of the Dow. Walgreens is on the list. They've got IBM and Cisco on the list. It's really hard to say. It's speculation, but it is really interesting. So listen to this quote. It's really interesting. A long time ago, when retail investors were more significant a factor in stock trading, you might scratch your head and say, what? Companies split their stocks to make shares more affordable to individual investors. Amazon did this 3 times in the 90s as shares ran up during the dot-com boom, and it stopped doing splits in the dot-com bust when the stock market took care of reducing the value of Amazon shares for itself. Now you can buy fractional shares, just about any of the publicly traded companies. But again, not all people can. International investors, not all the international investors can actually buy fractional shares. But companies still do it anyway, perhaps because it seems like bad form to have 4 or 5 digit share values. Amazon's also authorizing a $10 billion share buyback, which I talked about earlier. I'm not sure if that's the best strategy, but Jassy is saying, hey, this is undervalued. We're worth more than $3,000 a share, and we're going to buy $10 billion of our shares back. I think this is awesome. So what do you guys think about this? Let me know in the comments. In theory, Amazon could split the stock and we could see shares skyrocket back to the pre-split levels. So basically run a 20x. It says that would be wild, but consider that its shares are up almost 500-fold from 2001 low point, and people think Dogecoin is worth something. So, of course, if we try and travel back to 1999, the last time Amazon split its stock and told people that Amazon would run the internet's infrastructure, it would be, a major Hollywood story. If you think about it, Amazon's one of those businesses that's pivoted many times. You think they've pivoted into, AWS, Amazon Web Services. And now what's interesting is the advertising business. Do you know how large Amazon's advertising segment is? Let me just show you. So this is back on February 3rd. Amazon pulled its veil off its advertising business for the first time on Thursday, revealing a business larger than that of Google's YouTube. Can you believe that? Amazon reported ad revenue of $9.7 billion for the fourth quarter, up 32% last year and $31 billion for the year. YouTube posted $28.8 billion in ad revenue for 2021. That is actually mind-boggling to think that Amazon has that much ad revenue. Most people think, what ad revenue is there even on Amazon? But it's a huge part of their business, as well as the reseller category. So when you think of Amazon, it's not just e-commerce retail, it's Amazon Web Services of the cloud, and now this huge ad behemoth. And the ad tech space in general is very interesting, and it's really heating up. And this could be huge for Amazon for its future growth. So when you think of valuation, it's trading just under $3,000 a share. Now, if you look at this, guys, I'm going to go to a 5-year chart. This is on Y charts, okay? This goes all the way back over here to March 24th, 2017. Amazon price to sales, 3.034. Interesting. Where did it get here? 2.91. Where was it up here? So on September 4th, 2018, it was 4.87, okay? Then it came back to 3.3. March 2020, during the pandemic, okay, the price to sales ratio at that point, guys, got down on March 12th to exactly 3.012. It then rocketed all the way up, and it was way too expensive at 5.559. And it's come down from September 2nd of 2020 at a 5.559 all the way down to a 3 again. It's trading right now at 3.2. When it got to its lowest point, it was actually right at 3. You can see this right here. It bounced right off 3.045. So January 26, 2022 is 3.045. If you go back to this March 10th of 2017, 3.034. That's probably a pretty good time to buy the stock. It bounces off 3 every single time. If you can get this stock, and I've said it before, if you can get it at a 3 price to sales or less, the odds are in your favor that this stock is going to go higher over time. I think it's an opportunity, especially if it's 27.50. You know, at the beginning of the year, I made a video with the top stocks. I made an Amazon specific video. Go check it out if you want. It talks about all the great features of Amazon and where the stock might go, and gives you, much more of a deep dive than this video is. But I'm telling you guys, under 3,000 as a long-term investment, I think this stock is easily over $4,000 in 12 months. That's my opinion. I think that if you look at Amazon, they go through periods where they invest in growth, they invest in infrastructure, and then they go to a harvest mode, okay? Growth and then harvest. You can see these cycles. So here they're in growth mode, they're spending money. Here they're harvesting and so on. They're going to shift now into that harvest mode, and you're going to see acceleration, I believe, in those profits and those revenues. The other argument you can make is, well, you think of people with gas prices. Are you going to drive, across town to buy something now, or are you just going to buy it on Amazon and have it delivered? There's two sides to that story. One is more people might order stuff online because it's simpler and they don't want to pay for the extra gas costs. The other side of the coin is Amazon has to pay for those higher gas costs as well. So it is interesting to think about that. And, you think of air freight and all the different supply chain issues and logistic issues. They're going to face challenges, and I don't think that they're out of the water. So I don't think this is just going to rocket to the moon tomorrow. But I think over the next 4 quarters, they're going to figure that out. Inflation's going to start to get a little bit better. They're going to figure it out. They've got economies of scale, and I think that this company will thrive if you can get it at 3 price to sales or lower, dollar cost average, and hold. I believe this is going to be worth a lot more, especially if you have a 5 and 10 year time horizon. I personally own this stock, and I'm holding it unless the story changes till 2030. I hope this video is helpful. Drop me a like, subscribe if you haven't, click that bell to get notifications, drop me a comment. Appreciate your time and attention. Have a great rest of your day. Take care.